my name is Sadako Davis, and this is my Finance 381 Financial Analysis Final Project. So for this project, I had to answer 3 questions and do some research to find out the answers to these questions. The questions that we were proposed were, first, who would I issue a short-term loan to? To answer this question, I decided to research the company's net working capital and their current ratio. The second question I needed to answer is, who would I issue a long-term loan to? To answer this question, I researched the company's times interest earn ratio and their total debt ratio. The third question was, who would I buy capital in? Then I researched the return on equity and the dividend payout ratio and the PE ratio. So the net working capital is just the difference between assets and liabilities. The current ratio is current assets divided by current liabilities. It's a liquidity ratio, and it tells us how well a company would be able to repay creditors in the short term. The times interest earn ratio is EBIT divided by interest, and it just tells us the firm's ability to repay any interest. The total debt ratio is just that. It's total liabilities divided by total assets, and just tells us how much responsibility that a company has to other companies. Return on equity is net income divided by equity. Dividend payout ratio just tells us what part of net income goes back to the shareholders. And the PE ratio is price divided by earnings, and it just tells us a measurement of the firm's growth opportunities. The companies that I decided to research were Carnival Cruise Lines. Their ticker is CCL. They're a cruise line that operates 100 cruise ships within a portfolio of 9 leading global, regional, and national cruise brands. They're well known around this area because they have a port right out of New Orleans. The second company was assigned by the class, and it's Sanderson Farms. They're a poultry processing company which is engaged in the production, processing, marketing, and distribution of fresh and frozen chicken and other prepared chicken items. They're kind of well known around here because they have a plant right in Hammond. The last company that I decided to research was Shoe Carnival. They're known for their buy one get one half off offers occasionally, and they're just a retailer of family footwear. So to answer the question of who would I issue a short-term loan to, I looked at the net working capital and the current ratio for my 3 companies, and some things that stood out to me is that the net working capital for Carnival Cruise Line has been negative. They also have a current ratio that has been less than 0.3, which is very, very low. You would like to have a current ratio that was fairly high. That way you know that they have the ability to pay off any debt if something were to happen. Sanderson Farms, they have a net working capital that's been high and pretty steady over the years, so that's always a good thing. They also have a current ratio that stays over 2.5, which is fairly good. You'd like to have a ratio that's at least more than 1, so 2.5 is fairly well. Shoe Carnival, their net working capital has also been high and steady over the years, and their current ratio has been over 4, which is even better. So if you look at the net working capital chart that I've prepared, you can see where the Sanderson Farms and Shoe Carnival both have positive net working capital, whereas Carnival Cruise Lines has negative. Another thing I'd like to point out is you can see where Shoe Carnival and Sanderson Farms, their positive net working capital, this chart is in the millions. So whereas Sanderson Farms and Shoe Carnival have positive net working capital of $200 to $300 million, Carnival Cruise Lines has negative $5,519 million in negative net working capital. So that's not a good thing. If you look at their current ratio, you can see where Sanderson Farms and Shoe Carnival are up at the top. They're fairly high. They never get below 2.5, and ideally you'd look for something that was at least over 1. You can see down at the bottom, you can see Carnival Cruise Lines. They never get over 0.3, so that's not a very good ratio at all. So to answer the question of who I would issue a short-term loan to, I decided to go with Shoe Carnival. I decided on Shoe Carnival because they have positive net working capital in all the years that I researched and a fairly high current ratio to be able to pay off any short-term debt. So to answer the question of who I would issue a long-term loan to, I looked at the times interest earned ratio and the total debt ratio. For Corporation, the times interest earned ratio fluctuated slightly, and like I said, that is just a ratio of EBIT to interest. So you want to see how much money a company has earned and whether or not they're going to be able to pay the interest that is accrued. So there's fluctuates lately. There's not any big signal of anything. Just would want to keep an eye on it, make sure that it didn't dip down very badly. Their total debt ratio has also had a little fluctuation. One thing that I wanted to point out though about Carnival Cruise Corp is that more than 75% of their total assets are the actual ships themselves, which I researched on their company report a little bit, and they include their ships as part of PP&E, which is property, plant, and equipment. And over an average of the last 5 years, they've had over $32,167 million just in PP&E. So that's a really large part of their assets tied up. So for Sanderson Farms, their times interest earned ratio had a really, really bad dip in 2011, but since then they've recovered and even exceeded some of their previous ratios. Their total debt ratio has the greatest fluctuation between the three companies, and but they've also been able to recover that. Shoe Carnival, their times interest earned ratio is very, very high due to the fact that they have little to no long-term interest-bearing liabilities. If you look at their financial statements, they haven't had any long-term liabilities in the last few years. Their total debt ratio also has very little fluctuation. So here's the times interest earned ratio that bar graph that I have prepared, and you can see the dip in 2011 for Sanderson Farms and Carnival Cruise Lines. They have their little tiny little bit of times interest earned ratio. And then Shoe Carnival has the highest here, but like I said, that's because they don't have any or hardly any long-term debt on their balance sheet. Alright, so here's the total debt ratio graph that I created. You can see up at the top is Carnival Cruise Lines with the highest total debt ratio. You'd like your total debt ratio to be as close to 0 as possible, which is where Shoe Carnival is down at the bottom. Shoe Carnival does have a little bit of debt because they have, accounts payable and things like that, but overall their total debt is fairly low. And Sanderson Farms is in the middle. So to answer the question of who would I issue a long-term loan to, I decided to go with Sanderson Farms. Financially, my first decision would have been Shoe Carnival. However, since they don't have any long-term debt on their balance sheet, it signals to me that they're not in the market for any long-term interest-bearing liabilities. So financially, they were my best choice. However, market-wise, I don't think that they are interested. So I decided to go with Sanderson Farms because they have a high times interest earned ratio and a low total debt ratio. So to answer the question of who I would buy capital in, I decided to research the return on equity, the dividend payout ratio, and the PE ratio. Carnival Cruise Corp has had a slow decrease in the return on equity and the dividend payout ratio. However, their current PE ratio is 23.35, which is fairly high. The higher the PE ratio, the better, since their PE ratio signals how significant their growth opportunities are. Sanderson Farms, they took a slight dip in 2011 in this area as well, but they've been constantly rising ever since. Their current PE ratio, though, is fairly low at 7.63. Shoe Carnival has had a slow decrease in ROE and net income margin. And another significant thing is that they did not pay any dividends until 2013. And as you see in my graph, it's kind of odd in my opinion. but I'll discuss that later. Their current PE ratio, though, is 22.13, which is also pretty high, pretty far up there with Carnival Cruise Corp. All right, so here's the return on equity graph. Um, as you can see, there's that dip in 2011 for Sanderson Farms. That's really bad. But if you look at the years after, they've continued to grow and even exceed what they were in 2010, which was the year before. Shoe Carnival is fairly steady, so is Carnival Cruise Lines. All right, the dividend payout ratio, like I was saying, for Shoe Carnival, they didn't pay any dividends from 2010 to 2012, and then in 2013, their dividend payout ratio was 149, and then dipped down really low to 17.8. So that's just kind of odd to me. It doesn't signal to me as though it's going to be a constant thing. Whereas you can see Sanderson Farms and Carnival Cruise Lines are pretty constant in their dividend payouts. Sanderson Farms is a little bit lower than Carnival Cruise Lines, but they're still pretty constant. So to answer the question of who would I buy capital in, I decided to go with Carnival Cruise Lines because they've had a positive return on equity over the years and constant dividend payouts. They also have a very high PE ratio, which signals to me that they're going to continue to grow and become even more profitable, even though their short-term liquidity ratios and that aren't that well. If you think about it, a lot of their stuff is tied up in very fixed assets like a ship. So it's a little bit hard for them to be able to be very liquid. But they're making the earnings. So in recap, I would do a short-term loan to Shoe Carnival because they had positive net working capital and a high current ratio. A long-term loan, I decided to go with Sanderson Farms because Shoe Carnival had no long-term debt, who financially, looking at the financial statements, appeared to be in the best financial situation to take on long-term debt, but they're currently not in the market. Sanderson Farms had the second highest times interest earn ratio, and they had a very low total debt. So in my opinion, they were the second best choice, and since Shoe Carnival is not accepting, or appears to not be accepting long-term debt, I decided to go with Sanderson Farms. Who I would buy equity in, I decided to go with Carnival because they have a positive ROE and constant dividends. Thank you very much for watching. This was Sadako Davis and my Finance 381 Spring 2015 Financial Analysis Project.